Here's the wall almost every investor hits. You buy your first rental, it cash flows. Feels amazing. Then you go for your second one. And the bank pulls up your W-2, your debt to income ratio. And suddenly, that property that's making you money is the same reason they say no. Every door you add makes the next one harder to finance. DSCR loans flip that because the property qualifies, not you. I'm Jon Taw, mortgage broker. My team serves 49 states and we have partnerships with over 140 lenders and 400 loan products. I pre-underwrite every file myself before it ever touches a lender. So I watched this exact wall stop good investors. So let's run the numbers on a loan that gets them past this. DSCR loans, explained, the honest version. No hype, no magic loophole. If a loan sounds too good to be true, it usually has prepayment penalty stapled to it. And we'll get to that one. So what's a DSCR loan? DSCR stands for Debt Service Coverage Ratio. And here's the whole thing in one sentence. DSCR loans qualify you on whether the rent covers the payment. Not your job, not your tax returns. The math is simple. That payment is called P.I.T.I.A. Principal, interest, taxes, insurance, and any association dues. Picture a property renting for $2,400 a month. The full payment, the P.I.T.I.A, is $2,000. $2,400 divided by 2,000 is 1.2. That's 1.2 DSCR, Debt Service Coverage Ratio. The rent covers the payment with room to spare, 0.2, and the lender can see it in about 10 seconds. Now, what does a lender actually look at on a DSCR file? Good question. 4 things mostly. Your credit, your down payment, usually somewhere between 20 to 25%. Your reserves, meaning a few months of payments still sitting in the bank after purchase, and the ratio we just ran. There's even a program out there for 0 DSCR ratio and no credit score needed. Ask me about that. Here's what they don't ask for. Your tax returns, your personal debt to income, where you work. Hi, this is Jon Taw, mortgage broker. How can I help you? If you're self-employed, you know the feeling of handing a bank 2 years of tax returns and watching them frown and look at you. On a DSCR file, they never open them, and that's a beautiful thing. So, the property stands on its own. Therefore, you're not getting punished for being an investor who already has a few mortgages. This is where scaling actually happens. Every property you finance stacks onto your debt to income ratio. So, somewhere around the 4th door or the 10th door, the math stops working and the bank says stop. DSCR doesn't stack like that. Each property qualifies on its own rent. So the 10th one is the same conversation as the second one. And also, you can close in the name of an LLC. That keeps the portfolio clean, separates it from your personal name, and lets you build it like a business because it is one. Also, there are DSCR refinances. So if you have a rental property and you need to refinance for a better rate, now you have a high interest rate, you need to bring it down, you can use a DSCR refinance. That's how someone goes from one rental to a real portfolio. Not a loophole, a file that is set up right. Conventional loans ask how much you make. DSCR asks how much the house makes. When you're scaling, that's the one big difference, and it's the whole ball game. It's a whole new sandbox you're playing in. And we see tons of investors grow their portfolio this way. Now, let me be straight with you, because I'm not here to sell you a dream. DSCR loans usually carry a higher rate than conventional loans. You're trading a little on the rate to buy some flexibility. Whether that trade is worth it depends on your deal. A lot of these loans also come with prepayment penalty. That means if you sell or refinance too early, there's a cost. You want to know the number before you sign, not after. Remember, this is a tool. It's not a cheat code. Though it can feel like a cheat code sometimes because not that many people know about it, but you do now. If it's used wrong, it could get expensive. Used right, inside a plan, it's how you keep buying when everybody else got stopped. Yeah, the rate's a little higher, but on a low conventional rate, it doesn't do you much on the house when they won't let you even buy it. So here's where I start. Before you fall in love with the next property, run the numbers on the ratio. Set up the file right first. That's the whole game. Structure first, then you buy. This is first of the 4 videos I'm doing on DSCR loans. The next one is a DSCR for short-term rentals, the Airbnb version. And the numbers there gets interesting. Subscribe so you don't miss it. And if you want a second set of eyes on your own numbers before you make the move, everything's at jontaw.com. I have calculators there that you can run yourself. No pressure, just clarity. Let's run the numbers together.